guys, Brian Stevens here with Mortgage Shots. Listen, we actually had some good news over the weekend. I know that sounds strange, but here's the 10-year Treasury that you're looking at right now. You know how it's all but fallen off a cliff? Well, that's good news for mortgage interest rates as it increases the spread, giving many a mortgage company a financial reprieve, and it could also drop rates. And some are suggesting we could see rates in the 6s before too long. Now that's some good news. Last week, inflation data and testimony from the Federal Reserve President Jerome Powell were a plus for mortgage rates as the 10-year yield fell to a critical level of 4.2%. This has been a stubborn place to break lower. So the key for this week is to get follow-through bond buying after we close below 4.2%. Now, if it doesn't happen soon, then we're going to need to wait for more economic data or the Fed's talking points to push the 10-year yield lower. Now, when it comes to getting new data, frankly, I think the mood of this country right now is enough to get investors to more conservative bonds because, well, things look a little shaky right now, don't you think? Now, here's what you have to know. You see, if we took the worst level of the spread from 2023 and incorporated it to today's rates, mortgage rates would be 0.48% higher right now. Now, while we're far from being average with the spreads, the fact that we've seen improvement is really a plus over the year. So good news, but we do have a way to go. This week, it should be interesting for a lot of reasons. Moving on, guys, we have to be careful about our ECOA data. So Townstone Financial, based out of Chicago, just had a case against them reaffirmed by the CFPB. This has been going on for years now, and the truth is the CFPB doesn't have to win this case. They just need to outlast this mortgage company. In the summer of 2020, the CFPB filed a suit against Townstone, alleging that it violated reg of ECOA by drawing almost no applications for properties in majority African-American neighborhoods located in the Chicago-Naperville metropolitan statistic area of Chicago, and few applications of African-Americans throughout the Chicago MSA. So we know affordability has just gone off the deep end. We can accept that, right? We also know of the well-documented disparity between income and credit scores amongst many underserved communities. Now, credit scores and income are the two major categories when determining a person's credit worthiness. With Fannie and Freddie loans, they actually have loan level price adjustments that make interest rates higher for people with less money and lower credit scores. So it can be easy to draw the conclusion that the very metrics by which the GSEs extend credit is in and of itself some form of redlining. It's kind of unavoidable. Yet this case, which I've been watching for a number of years now, I gotta tell you, I disagree with the findings from the CFPB. Leaps have to be made in logic to draw these conclusions from these guys. Yet here they are nearly 5 years later. So word to the wise, many companies are going to need to work extra diligently to seek out and fund more loans in underserved communities. Really make this a priority because remember, disparate impact is if the outcome is disparate. Intent means nothing. I hope this helps.